Imagine this. You've worked hard, you've built your career, and now you're looking at your personal balance sheet and you see a net worth of over $3.2 million. You might be thinking, I'm all set, I can retire. Well, not so fast. In today's video, I'm going to be breaking down a real life scenario I encountered as a financial planner out in the field, where a couple earning a high income with multi-million-dollar net worth wasn't even close to being ready for retirement. And be sure to stick around to the end, because I'll be sharing exactly the input that I gave them to help them get on track with their retirement planning, to see what they can do to get where they need to be. I'm Joe Boughan. I'm a certified financial planner and the founder of Parkmount Financial Partners. And if you're ever wondering about whether your retirement plan is really built to last, this video is ideal for you because it can be a nuanced situation. The problem with most of financial advice today is that it is too generalized. People read something online like 2 million is enough to retire in XYZ state, and they think it applies to them. Having a unique financial plan that is really tailored to your lifestyle, personal values, and risk preferences and goals is the only way I feel to get real assurance as to how well you are tracking towards your goals for the future. And the results could surprise you. I've conducted hundreds of one-on-one consultations on individual financial plans, and this case study will give you some insight as to exactly why it is so important to have a personalized roadmap and not to rely on just out-of-the-box rules. So first, let's meet John and Jane. They are, of course, fictional names, but the story is very real, with some small details altered just to make this story more digestible in a short video that we have today. John and Jane are in their late 50s, earning a very healthy income as they are both working. They've got 3 kids, 2 are in college, 1 just entering the workforce, and they want to retire in 5 years. On paper, their net worth looks solid, $3.2 million. But here's the catch. It's not all liquid. As we break down their balance sheet, they own 2 homes, both with mortgages on them. One is a vacation home worth $1 million that they plan to keep in retirement and renovate. And their actual retirement savings is about $1.7 million, split between IRAs and 401ks. John has $600,000 split between 2 retirement accounts, and Jane has $1.1 million split across 2 retirement accounts. Now, the monthly spending reality. We need to break down how everything stacks up from a cash flow standpoint to see if they are able to catch up to where they need to be in retirement. Even if you're earning $1 million per year, but you spend a lot more than that, you could very well still end up broke. In this situation, John and Jane earn a combined salary of over $800,000 per year, but they currently spend $30,000 per month, and in retirement, they expect to need to spend $20,000 per month net of all tax. Sounds reasonable, right? Well, let's run the number. If John and Jane want to spend $20,000 per month in retirement, that will be $22,000 per month in 4 years due to inflation. Now we have to think about taxes. So when we gross up for taxes, they need a gross income of about $30,000 per year from their portfolio to meet that spending goal. Now, not all of that needs to be withdrawals. When they file for Social Security at retirement, this leaves a gross withdrawal of roughly $234,000 needed from investments in order to satisfy their living expenses for their lifestyle goals in retirement. That's a withdrawal rate of over 10%, way above what is sustainable, even if you do believe the 4% rule is pretty conservative. Now, this is where we address some gaps. John and Jane were shocked. Given their high net worth and the fact that they were already working with an advisor for a number of years in order to get on track, they need to start saving a lot. And given their high income, we explored the possibility of redirecting more of that income to current savings to get on track. But unfortunately, we came to another series of obstacles there too. Given the current college expenses, which were high, and a significant amount of current credit card debt, and an upcoming planned boat expenditure of $150,000, we were unable to get to an agreed saving amount much greater than what they're currently doing. Unfortunately, they had worked with another financial advisor for years who never flagged these issues. And as you get closer to retirement, you're losing the benefit of time to work for you to make adjustments to achieve your goals along the way. So what were the solutions? How can we address this financial plan shortage? Well, we talked through several key levers. First of all, they could work long. Just 2 more years of high income could make a significant difference in getting them on track for their goals. And then, of course, spending less, reducing retirement lifestyle from $20,000 to $16,000 could have a big impact on the overall plan viability. While this isn't something easy to swallow for everyone, it could have benefits. And finally, adjusting the asset allocation. With 5 years to go, we could shift their portfolio from a traditional 60-40 allocation to a more growth-oriented allocation with 90% equities. The long-term return potential is increased, but it does come at a cost, with potential for significant volatility increase. They were very comfortable with that trade-off, given the high risk tolerance and the potential to improve their outcome without making significant lifestyle adjustments. We also discussed eventually using home equity as a backstop needed, but given the fact that they hope to leave a legacy to their children and they don't really have end-of-life care planning in place for long-term care type coverage, I do believe that even using a significant amount of equity may have a limited effect on their overall probability of success in their plan. So what was the outcome? Well, after modeling the new strategy, their retirement plan looked better, but I do think we still need to work and come up with solutions on how everything shapes up. Saving more, trimming lifestyle goals, it's all part of a bigger equation. And if we can do a little bit of everything, maybe we can get on better track. What's important is that they clarified where they stand and they no longer have a false sense of security. They had a real plan and they're no longer trending to run out of money as long as they're willing to do something about it. So if you're a professional working in the tech industry, defense industry, biotech industry, or you have stock, RSUs, or just a complex financial picture as you're evolving in your career, don't wait for a surprise to talk with someone like John and Jane. Click the link in the description below to learn about how financial planning can boost your bottom line nest egg. You can explore strategies that we'll use in this video to make retirement planning more viable for a bright potential future ahead. If you found this video helpful, please hit the subscribe button for more financial adventures ahead.